Ah, we're live. It's Monday and we're back. Another episode of Go FUD Yourself. Again, just a quick reminder, slightly different format for this season of Go FUD Yourself. We're doing like a little bit more evergreen, larger macro topics on Mondays and then fill it in with some news. And then we're doing some really cool like roundtable discussions every 2 weeks for now. FUD with friends on Fridays, which is super exciting.
Starting this Friday, hopefully.
Starting this Friday. Pretty exciting topics. We'll share them very soon. Anyways, today we're talking about what? What are we talking about?
We're going to talk about restaking. We're going to talk about restaking so friggin' much for a full half hour. First of all, we're going to do a quick restaking overview. It'll only be like 5 minutes. If you already know what restaking is, just stick around because then we're going to dive into the risks and rewards of restaking. We're going to talk about restaking on multiple networks. We're going to also talk about some restaking news and the concept of liquid restaking. So it should be good, I think. There's a lot of buzz about restaking, and I kind of thought that the restaking conversation would die after ETH Denver, and it hasn't. It is only picking up speed. So
it's a prevailing narrative. I say, let's go. All right.
JD, what the FUD is restaking?
What the FUD? Yeah, so I think there's a good amount of maybe not misinformation, but there's a lot of people I think that misunderstand kind of what restaking is relative to liquid staking and eventually to staking, just plain staking. We're going to delineate the differences between the three of them today. But restaking is kind of like probably one of the bigger narratives. AI, restaking, shared security, stuff like that is a pretty solid narrative right now. Eigenlayer really was kind of what brought this all into public consciousness, which is still largely not understood. So, but seriously, Eigenlayer, like very few people in the Eigenlayer ecosystem are even aware of how to launch an AVS, how this is all going to work. But the idea and the concept of restaking has been very well received. So I'll try to give you like a basic understanding. So the way it works is when you start a new blockchain or a new protocol or an app chain or all these other things, you have to borrow some security from somewhere else, or you have to get to massive market cap so that your security is big enough. There's enough value that's securing the network that it doesn't make it really cheap and easy to either take over the network or exploit or all of these other things. So examples of this are every L1, maintainer, Ascending Man. I see you're excited about liquid staking too. Anyways, whoa. So anyways, the way restaking actually works, I didn't expect the overlay. It's kind of cool though.
You're killing me. Tell me what restaking is.
I am. I'm trying to get there.
3 minutes and I still don't know.
Okay, restaking. Essentially, you liquid stake on another network and you bring that shared security while still validating on that network and gaining your rewards. You can use the liquid staking token to also help secure an additional network. So there's examples of that. You can go to Renzo, check out Renzo on Eigenlayer, good friends of ours, Lucas, he's a friend of the pod. There's a lot of things that you can do, but the idea here, again, and the reason I gave you this whole preamble is the idea here is to say, okay, let's say I wanted to launch a new L1. Instead of having to go out and raise money at like a $1 or $2 billion market cap and then try to, bribe everybody to validate for the first like 2 years before the chain actually picks up. This is a very efficient, very capital efficient way for protocols, projects, developers to launch with solid security. And it's a really good opportunity to stack yield for users. So it is good. It is really exciting. Not without some downsides though, which we're going to talk about.
Hold on. So you stake crypto right now, mostly ETH.
Yep.
You lock your tokens into a network, and then you can restake on a different L2.
That's right. So here's an example. Avalanche, you would use Benki liquid staking and you would get AVAX. You would take that AVAX and bridge it to Eigen. and then you can deposit it into Renzo, or there's a few other protocols that also are focused on restaking. I think Renzo has 4 billion or something in TVL already. Now, I don't think they accept AVAX right now, but eventually that's the idea. The idea is to allow security being shared amongst maybe many networks, right? So you might have restaking of some AVAX tokens in there, some ETH in there, some BNB in there, and it helps to diversify the security makeup of a network, of an app chain, or a single app on its own chain. So anyways, super exciting, but there's a bunch of risks that come with it. I know we're going to talk about that in a minute, but maybe you want to go through some of the key features.
So it sounds to me like the biggest reward is obviously yield generation, right, for the user.
And
then there's also kind of like a security diversification component in terms of the networks.
Well, that, and it brings down the cost and the complexity of launching a new network. One of two things happens. There's a decision that's made when networks launch. Do we want to validate this with our own asset? And if so, how are we going to get enough liquidity validating the network that whatever the actual applications are have less liquidity than the validation? Otherwise, it would be cheaper to buy all the validator tokens, manipulate the network, and take all the money. So it's pretty important that you have, I think, multiple tokens in there, because then you're not taking just the risk from BNB chain. What if BNB dies, or what if AVAX dies? ETH won't, of course. I don't think BNB or AVAX are going to die either. But anyways, it's a big piece of capital efficiency for developers. It really does matter.
It's interesting you talk about, in case a network dies or something, but that's what I hear a lot of in terms of L2s, is if I can stake on all of these L2s, I'm kind of hedging my bets. Does that make sense?
To a certain extent, yeah. I mean, developers are willing to pay for this. Obviously, it's not free. You have to give out validation rewards and yields and so on for the restakers. That being said, it's probably significantly less as a total cost than it would have been otherwise. So yeah, it's pretty exciting for developers. I think that's why Eigen has blown up, is because this really is, again, kind of a stepping stone over one of the big challenges in the space. And that is, how do you get to a meaningful security posture for a new network or an L2?
So we have talked about some of the rewards now. There's like high yield, right? Multi-network diversification, security. But the one thing that is on everyone's mind is, what about slashing penalties? And although we are going to talk more deeply about the risks and rewards later, I just kind of wanted to jump on slashing penalties here, because as much as you diversify in anything and you have the potential to get rewards, you also have the potential to have a risk or be penalized for something. Have you seen many people get hit with slashing penalties?
Not a ton. I mean, it does happen, obviously. It's there to penalize less than desirable behavior, not necessarily malicious behavior either, right? So what's really critical to these networks, obviously, is uptime, finality, having enough validators online with the right components of hardware to be able to actually validate at speed and at scale. And if your validator keeps going offline or different things happen, that's kind of where this slashing comes in. So generally speaking, most of the major validators on most major chains are now corporate entities and so on. There are a lot of people still individually staking, but the biggest validators are generally enterprise. And so those ones, they've got totally different fail safes and different things for this. But slashing is a real risk, obviously. And it can be, in some cases, significant. It depends what networks you're actually validating. Something definitely to pay attention to.
Okay, I'm going to break this down just to ensure that we're all on the same page. I've got 100 ETH. I liquid stake that 100 ETH, and then I can restake that 100 ETH on a normal protocol like Uniswap. Is that right?
No. No. Well, I mean, I suppose you could if there was the representative asset you get from restaking.
Okay, tell us step by step how one might participate in restaking. Yeah.
Okay. Following my example from before, although this isn't currently technically possible, it's an easy example to understand. Yeah. You buy AVAX. You're a fan of Avalanche for whatever reason. You think it's great. You think the price is going to go up, number going to go up. You buy AVAX. And then you're like, okay, well, I'm going to hold this for a while, but I might as well, what are the yield opportunities for AVAX? And the first one is liquid stake on Benki liquid staking, and then you earn the validation yield on your AVAX for Avalanche network. What you get when you deposit into Benki liquid staking is a representative token called SAVAX. You would take that SAVAX to another network then that is offering restaking rewards. I think we're going to talk later about Solana, but for now, let's use EigenLayer as the example. You go over to EigenLayer, bridge over to EigenLayer, and then you have to deposit your SAVAX token into one of the platforms to then secure one of their partner networks, so on and so forth. I'm not.
Do you have to switch networks? Can you not stake on ETH and then go to another protocol and restake?
Depends if it's an L2. ETH is a little bit different, but let's not get into the too deep in the weeds on that one.
I just wanted to check because that's what a lot of people's questions are surrounding. Is like, do I have to go to a different network? What if they aren't an AVAX maxi, right?
So what you're actually doing is you're not taking your AVAX to a different network. The Avalanche tokens are still sitting in the validator on Avalanche doing what they're supposed to do. So that's where this is a little bit different. You're just bridging the representative token, not the underlying asset. It's worth noting, though, that there will be second order use cases, I think, for what to do with the receipt token from depositing and restaking. You might be able to use that in lending at some point, but it's starting to stack risk upon risk upon risk.
Right.
And so we're going to talk about the risks in a little bit, but I think it's definitely worth noting that this sounds great in principle, but there are a lot of relatively hidden risks here that hopefully we're going to highlight today.
Okay. Two big questions before we totally move on to the risks and rewards. One thing that I kept finding people asking on forums yesterday was, how is restaking different to liquid staking? And you are a liquid staking expert, so.
Well, I don't know. The bar must be pretty low if I'm the expert.
You are a liquid staking expert, so yes, it is.
Okay, perfect. All right, no risk, no rewards. That's right, Ascending Man. Just have to understand the risks so you can price them into what you're doing. That being said, liquid staking, obviously, I explained that before. You hold a network token because you believe in that network, most likely, and you want to participate long-term. You also want to contribute to the security and scalability of the network, obviously, but you're not super inclined to run a validator yourself and mess with the hardware or the cloud costs and yada, yada, blah, blah. So you just go to a liquid staking protocol, and instead of validating yourself, you just deposit into liquid staking, and that protocol, in this case, Benki liquid staking, manages the delegations and stuff for you. And so it also, liquid staking protocols also often will smooth the impacts of slashing. So if one node gets slashed, it's not the people that actually had their tokens delegated there that all take a hit. All of the people in the liquid staking pool, it gets kind of amortized across a bunch of people. And so it becomes negligible, which is pretty cool. So again, validation is when you run your own hardware, or you have a cloud instance of a node. There's some costs associated with that, a little bit of technical complexity. It's not super difficult, but it's also not super simple. And so some people like to do that. You do earn a little bit more by doing it yourself, obviously. But most people don't want the headache of managing all of that stuff. So they use a liquid staking protocol. Another major benefit of liquid staking is you free up the capital efficiency inside those tokens. So same example, AVAX. Let's say I've got $5,000 in AVAX, and that's like 50% of my portfolio. I like AVAX. I want to validate and contribute to the security and scalability, but I also want to participate in some other DeFi and use some of the equity, so to speak, in those assets without selling. Liquid staking allows you to do that with that representative token. And one of the options for what to do with that representative token is restaking, should you choose to do so.
Amazing. Okay, let's dive into risks and rewards of restaking. So first of all, we've talked about the financial incentive. You can get higher yield. You can participate in more stuff. You can get more rewards because you're participating in more stuff. But that adds a layer of complexity.
Yeah, and I think most staking and liquid staking yields are variable. So Some of the risks there are if you're using your assets in subsequent workflows, you need to make sure that the interest rates somewhere don't go bananas. Because if they do go bananas, you could, in fact, find yourself liquidated and different things. Financial incentives, I think the major risk, since I am talking about risk, because that's who I am, and you're going to talk about rewards. But anyways, I think that the risk there really is just understanding that those financial incentives may change, and you have to monitor it to make sure that
I think that's the case as a user, right? But there are people saying that this complexity could cause some destabilization too.
Sorry, my dogs were going bananas, so I had to mute for a second there. Go ahead. What?
Just I'm talking about the next point, which is that yes, there are risks and there are rewards for the user, but there's also potentially risks and rewards for the ecosystem, right?
Yeah. So I alluded to this earlier. I actually didn't know there was going to be a quote here, but Adam Morgan McCarthy from Kaiko highlights the danger of collateral on collateral, which is the quote. And this could destabilize the crypto market if investors rush to exit. So this is kind of a similar example to the derivatives of derivatives of derivatives that led to the 2008 collapse. So that if often many of these stacked collaterals or stacked liabilities, the dogs love yield, bro. The ascending man is asking if the dogs are excited over yield. Yeah, of course. They love it. That's what they live for. Anyways, so you stack on all of these kind of risks, and all it takes is one of them to go sideways, one of the layers of that pie to have an issue somewhere, and the whole thing comes crashing down. So validating the primary network has some risks for the network itself. If their validators collude or whatever, there's some risks for the network. Liquid staking adds another layer of risk on that. Now you have the same risk of validation of the network and the validators, but now you've got another layer of smart contract risk and another layer of peg management, because in the example we've been using, AVAX has to stay relative to AVAX in price. Otherwise, it's hugely problematic for everything subsequent. So, I mean, now you add restaking on there, and now you're another layer of smart contract risk, et cetera, et cetera. I know I'm going on about this, but
yeah, that's too much.
But
the other cool thing about this, in terms of reward, is that it could be volatile, and degens love volatility. Yeah, so even though we don't love when things go down, degens do typically love when things are exciting. And so as volatile as it might be, this is super novel. And as complex as it might be, this means people have been more engaged with it, right?
Yeah, I mean, the yield is very attractive. So again, you have to figure out what the kind of efficient frontier is. How much risk are you willing to take for that amount of yield? And you have to make that assessment yourself.
Okay, do you think restaking is going to be the next Terra, though?
The next what?
Do you think it's going to be the next Terra, the next Luna?
Terra Luna? I hope not. I've had some conversations with some fairly sophisticated mathematicians that are a little less than confident in the ability for restaking to actually scale and work at scale. I don't really know, but I wouldn't rule it out, I guess. Not that it's going to be exactly like Terra Luna, because that was quite a bit different, but it's a similar kind of conceptualization of that in a sense.
Well, yeah, we do have more and more institutions coming in too, right? Institutions are already using restaking, like SCB Limited and Nomura Global. They're in here. They care about restaking because they also see the yield, which also means maybe more regulation. So perhaps that will push off something happening like Terra Luna, or maybe it makes it happen sooner because there's more money.
Yeah, I mean, institutions are coming on board and starting to support this. You see it a decent amount with ETH. Larger institutional holders have really big bags of ETH and want to earn some yield on them, obviously. But I think there's been a few of those kind of fairly notable collapses. FTX, Alameda, Three Arrows, Celsius, et cetera, Terra Luna, Anchor. There was enough of them that I think institutions are also waking up to some of this stacking risks and are trying to assess it. So it's taken some time for us to get AVAX widely accepted by institutions, but once you get there and once you get it supported by major custody providers, et cetera, then it does open the door a little bit more. But the scrutiny is very high. So
Absolutely.
yeah, I think we're going to see more and more institutional involvement, especially through custody. But they just have to understand it. And we have to be a heck of a lot better at explaining it and representing the brand.
Okay, we've talked about incentives, we've talked about complexity, we've talked about degens, we've touched on institutions and regulation. But what about, you know, everyone loves Vitalik. Tell us about systemic risks that especially Vitalik is predicting here.
Yeah, so one of his major criticisms is that restaking could pose fairly large systematic risks to an ecosystem and leading to some instability. So I'm going to give you an example of that. Again, I kind of said it a little bit earlier. Vitalik's obviously an authority on this kind of thing, so it's nice to echo his sentiment, although I happen to completely agree. Anyways, it's one of those things that if any one of the restaking assets itself comes depegged, or one of the liquid staking protocols, it's not even if AVAX dies in my example, it could be if Benki liquid staking is exploited.
Right.
The cascading effect that could create some serious instability in these restaking platforms should not be ignored. And that's what Vitalik has been saying since day one. He's actually, there was discussions, I think, early on, and someone can correct me or fact check me on this, but there was discussions early on where they were actually trying to prevent restaking on Ethereum as even being an option. Yeah. Somehow that didn't come to pass, obviously. But
yeah, because don't tell me what to do.
Yeah, I mean, I feel like I'm being super fuddy on this whole thing because that's kind of just who I am. But I've been saying this for a while. I love it. Obviously, we participate, and I'm a big, proponent of finding ways to move the space forward. I'm just a little bit cautiously optimistic about restaking. That's all.
Okay, I'm going to talk a little bit about how this might be good for ecosystems and for devs and or those who are launching something themselves. You have already talked about how this creates stability for people launching something like an L2, how it allows them to get some higher yield, maybe have more token incentives, maybe actually get more transaction income, that kind of thing. But there's also a developer element here where they don't necessarily have to run their own validators the same way. So there's much lower barriers to entry. Do you think that this means people are going to be able to innovate more because of restaking, because they're not going to be spending all this time setting up validators, or is it too much of a nothing burger?
There are other ways to facilitate just that piece alone. We actually have a system where you can rent AVAX and validators on Benki so that you can have it as OPEX instead of CAPEX. A lot of these institutions can't even hold the ecosystem token on their balance sheet. So for them to have a bunch of tokens and be validating and running all the hardware, in many cases, it's a fairly big lift. Here's an example. Launching a subnet on Avalanche or a zone on Cosmos is probably going to cost you somewhere in the neighborhood of a couple $100,000+ just in the ecosystem token, just to have enough validators seeded to run the network. But then your security is only as good as how much value you have locked running that network. And so that's kind of where the restaking comes in. In terms of developers, though, yeah, I mean, most developers are either trying to get product market fit and then go raise some money, but they likely haven't raised money before they'd have to, prove that their product actually works on its own network. So, I mean, all of those things are made substantially easier by this, but definitely good for devs.
The other thing that, for me, this is the big highlight of restaking, is the interconnectivity. So we're always talking cross-chain, multi-chain, omni-chain. There's a big push right now for cross-chain governance of DAOs. People love bridging safely and not being exploited. Sounds exciting. And we're seeing that restaking is coming across more and more networks. So we've got ETH, Solana, Near, Bitcoin, Avalanche, if you're liquid staking on AVAX or something like that and carrying it over. Do you think this is the way that we're going to see that omni-chain movement in DeFi?
I don't think it's the way. I think it's possibly one contributing factor to how to secure transactions across chains and all of these different things. We have some really interesting ideas for that. I'm not going to go too deep into them today, but I think it's definitely going to contribute, I think, to how to help or to allow protocols to be a little bit more selective on where they launch. They're not just having to launch where the liquidity currently is, but rather they can start seeking ecosystems that have the technology that best suits their protocol, regardless of excitement. And I think that's really cool also, because we'll see more innovation and more adoption of novel products, especially if they can launch on an ecosystem that actually makes them a market leader, right? So it's, I think it's definitely interesting. There's a few other pieces of omni-chain or chain abstraction, I think, here, but this definitely could contribute if we get to that point.
Okay, let's wrap up talking about liquid restaking, which is specifically coming up on Bitcoin. So we had a couple news articles. We'll just run through the news quickly and then really talk about it. So BounceBit has launched a liquid restaking infrastructure for Bitcoin, extending the concept traditionally seen in ETH-based applications. This platform aims to enhance the utility and capital efficiency of Bitcoin by allowing the restaking of shared tokens, thereby enabling various financial activities and increasing security for the Bitcoin network. So this is exactly what we've been talking about all episode. And the reason I wanted to bring it up is I think that the term liquid restaking is a little bit misleading. I think people are trying to use it as a new term when it's actually just describing what we're already doing on ETH.
Pretty much, yeah. I mean, the major difference here, and the reason they call it liquid restaking as opposed to just restaking, is they're implying that there's going to be a subsequent use for the receipt token from restaking. The reason I'm not stinking bullish on that quite yet is because we've already added a significant risk vector to the equation. And this would make it even worse. It's, again, another version of leverage or collateral on collateral on collateral. And eventually you end up with kind of this dominoes effect, that one little thing goes wrong and the whole thing comes crashing down. That's the major concern of most critics. I'm probably in the middle somewhere. But anyways, I don't see any subsequent DeFi protocols accepting these liquid restaking tokens, because the risk is so impossible to assess. Yeah, like you just can't assess it as a protocol. We wouldn't list them on any of our protocols at all right now.
I do want to note another term that's coming up in terms of liquid restaking or in relation to liquid restaking, which is the dual token economy. And this is the idea that you have your standard token and then you have your stakes token, and then maybe it'll be a tri-token economy where you have your liquid stakes token or your restake token or something like that. But I find this funny too, because it's almost like the daymare and the nightmare. Like you're running the same things are happening. It's not like there's some sort of novel utility that you didn't have previously using these different tokens. But in reality, this isn't really that different from what people are doing in DeFi anyway. So I think that's also a little bit of a nothing. Yeah,
I mean, just to comment quickly on that before we wrap up here, but I think I think there's a lot of complexity being added. So we've spent the last year talking about how one of the most important things, at least from my perspective, is fixing the user experience problem we have and trying to make onboarding to crypto less confusing. We're adding more and more versions of the same token and more bridged versions of the same tokens. And it's starting to create, in my opinion, unnecessary complexity. So we're actually going backwards in some ways. We're creating new options for the people that understand it, but we're making it that much more difficult for new people to come in. So hopefully we don't get too far ahead of ourselves stacking risk on risk, and we can figure out how to actually explain this in an easy way.
I do want you to tell us about KelpDAO's raise, because I think that was from last week, and it just shows how stoked people still are on restaking. Stonking.
So they raised $9 million at a $90 million valuation. It's a pretty significant step as they look to expand their services to major blockchains, including Bitcoin and Solana. And so Solana's been kind of in the news a little bit lately, but trying to figure out how to create kind of this app chain marketplace, and restaking has been kind of the primary way to do that. Nonetheless, I think they're really looking to expand. Raising 9 million at 90 is pretty healthy. It's a lot of money to build a restaking platform where the overhead is quite low. But I mean, that's a lot of cash, and it's a lot of people willing to throw their money at it, which, I don't think it's too bad. There's a few significant participants in that round. 2 in particular accounted for 3.5 million of the 9 million. That's a pretty bold bet from those guys. That being said, although I don't think they're going to get to a point where they've got valuations in the billions right away. I've been wrong more often than I've been right. So I wouldn't be surprised just because of the narrative and the excitement and the kind of sexiness of restaking at the moment. It might go crazy. I don't know. I'm definitely interested to see what happens on Solana, because Solana, for reasons that I still don't understand, remains to be kind of in the top 5, top 10, and is holding value and holding community. But they really are having a hard time with how the heck they can expand and not continue to cluster F the main net. And so this is pretty exciting. I think there's definitely some opportunity on the Solana blockchain for this. So be cool to see what happens.
Exciting. Well, thank you, JD, for diving deep into restaking. I hope this was a little bit more than a 101 for degens. Now you know some of the basic risks, some of the basic rewards, you know what you can actually do with it. And you can watch out for scams, and you can watch out for lies, and you can watch out for FUD.
I'm usually a fan of belly flops over deep dives, but hey, we'll do what we have to do. I mean, honestly, this is one of those things. Before you dump in with your entire portfolio, please do your research and understand it.
Yeah.
There is more risks than most protocols are willing to advertise. So just make sure you understand. Yeah. Sweet.
Amazing.
That's our Monday. Staking, liquid staking, restaking. We didn't even talk about staking. Maybe we'll talk about that some other day. Anyways, hopefully you all have a good week. Friday, 12:30 p.m. Eastern, we're doing the roundtable. It's going to be the first one, fun with friends. Super stoked about it. So yeah, make sure you set a reminder, like, share, subscribe, hook us up. That's it. That's all I got.
JD. Go FUD yourself.
Go FUD yourself.
With that, I have to say, go FUD yourself.
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 I like that ending a lot.